live. And how it works is we're just going to share one or two insights from the book, The Power Law, by Sebastian Mallaby. And Sebastian's also here as a guest, which is super exciting. Welcome, Sebastian. Thanks for joining. So we'll start off with our team, the launch team. We'll pick 3 or 4, and then we'll go down the list asking of insights from the book, and maybe what resonated with you, what stood out, and maybe if you want to ask a question, clear and concise question to Sebastian as well, that could be fun. So we can go ahead and get started. I'll go ahead and get started here with an insight that I probably have an hour left in the book. So I've got, if everyone can mute yourself if you're not speaking, that would be great. So insight that stood out to me. So overall, generally speaking, I think just, venture capital, like the OG investors, like Tom Perkins, Eugene Kleiner, the Don Valentines, all of them, just how hands-on they were as investors was really fascinating. They would, be in the trenches with the founders, where like as a young person in venture, you don't see too much of that other than like the old school investors doing that. You see a lot of like funds nowadays, just kind of deploying capital. And then if you take a look back at the history of venture, you see these incredible investors and how involved they were at the early stages of these companies, and how important that ended up being for the success of the companies. So I thought that was really interesting. And then real quick, the other thing in chapter 13, which I just really liked, was specifically the story of Sequoia celebrating the success of not only the company, but everyone part of the deal that got it to that point of success. So I think the example in the book was with WhatsApp. And so typically media, and to this day, kind of still works like this, like they'll just highlight the partner of the deal and give a kudos to them, and then not kind of recognizing or acknowledging, everyone else involved to get it to that success. So Sequoia does the cool job of this. It just kind of shows how intentional they are and mindful they are with everyone part of the deal. So the example was WhatsApp. They go ahead and they highlight the partner, Jim Getz, who led the deal, but then they go on and they list like a dozen other folks that participated, down to like the office assistant who helped the founder with, I think the example was the founder was on a drive to Facebook to close the deal of the acquisition, and his car broke down, and then the assistant jumped on it and got him a car. And so like something that could be seen as very small, is still recognized at a firm like Sequoia. So there's a lot of appreciation for that. And it goes to show, like, again, how mindful they are with this. And it translates to their success, and the consistency of success, I think was super cool. So that was my insight that I liked. And so I'm going to pick another launch team member to go next. Heidi, are you here?
Hey, everybody. Yes, I'm here, Presh. And I always laugh that it's great to follow you with your insights. I think my favorite quote in the book is from the wrap-up section. I think it would technically be chapter 14. Success leads to success because of reputational effects. And I think when we think about that here at Launch, venture really is a reputation business. So our ability to do and say what we say we're going to do and actually do it and mean it is really paramount to not only our success, but really success as venture as a whole. So if we say we're going to support founders, we best do it. And I think that we do that through not only our accelerator program, but also Founder University, and really giving a community, building a community for founders to come in, learn how we teach the venture capital business. And then just in general, whether it's figuring out how to help someone pitch, how to write their deck, how to make a FAQ, just overall in general, everything that we do it for the founders and for the business in general. And that really kind of spoke to me. And it seems like it would be an obvious, like, hello, your reputation is everything. But when I read those words on my iPad, I was like, yes, this is 100% accurate. And I'm proud to say that I hope that we do that here for our founders.
Love it. Great job, Heidi. All right.
You should give
Charlie.
Sebastian a chance to answer that or expand upon it.
Oh, sure. Sebastian, you there? Oh, you are on mute if you're talking.
No, you can hear me, right?
No, you're good.
Okay, good. Yeah, I liked all those comments. The reputation point is subtle because I think it's super important for VCs to build a reputation, just as Heidi said. But at the same time, I was arguing against the idea that reputation is kind of all you need. And once you've got it, you're made and you can never descend the league table. Kleiner Perkins clearly proves that was untrue. They were, the top partnership in the world. In 2001, if you look to the Forbes Midas list, they had the very top investor, which was Vinod Khosla, and the number 3, which was John Doerr. And then if you look 20 years later, Doerr was down at 77, and nobody else from Kleiner, nobody was in the top 100. So they went from hero to zero. So you can have a reputation and you can screw it up. But in general, yes, reputation, of course, does matter. And I think Heidi's point is well taken.
I'm curious, as a follow-up to Sebastian, and thanks for doing this, by the way. And thanks to everybody for buying the book. Such a good book. When people are sharp-elbowed and there's a founder conflict, does that actually damage the firm or not? Because I think a lot of VCs have deferred to being founder-friendly, but other firms have held the line on founder responsibility, let's say, or don't have a hard time maybe not replacing the founder, like you talked about early in the book was kind of a standard, Don Valentine and Kleiner and everybody replacing founders, but then there are times when founder accountability does matter. And does that, if you're holding founders accountable in today's era, do you think that is going to be a reputation damage or actually a result in respect and more reputation?
Jason, this reminds me slightly of the debate we had about whether, I think the question is whether it was smart for A16Z to fund Newman and give him a second chance. And I began by saying, no, that's too indulgent to a founder who misbehaved. And you persuaded me that I was wrong. And actually, it's if you believe in backing the kind of extreme founder who might be the outlier, who does the better than 10x, Adam Newman is in that category. But on this question about reputation, I think it can cut both ways. I actually was at a offsite over the weekend with a famous Valley VC firm, and I was chatting with some founders who were there, and they were saying, well, clearly this VC firm is a really, really strong one, but the one thing we worry about is that they seem to have a habit of switching out the founder for a different CEO. And, as founders, we're not sure we like that. So I think it factors in. I think if your brand as a top tier firm is strong enough, you overcome that because ambitious founders want to go with ambitious VCs. And part of ambition is to, stick your neck out and be aware that if it doesn't work out, you may be replaced. But I think it can't be the case that it's no impediment. If the founders know they may lose their positions against their will, they're going to think about that.
Okay, Presh, take another question.
All right. Let's see. Amber, want to go up next?
So in chapter 11, one of my insights was there's no control over the luck involved with hitting a winner. However, there's control over the process. So just going into the culture of training and trusting young investors seem to hold the secret to success. An example in the book was Kleiner hiring more women in the industry, but they kind of failed to advance their careers. And then when Excel hired fewer women, they were more successful at empowering them. So what are my insights?
I'm glad you picked up on that. I've been thinking a bit about the way that, whenever I begin an investment book, whether it was about hedge funds, a dozen years ago, or about venture capital now, initially I'm looking for sort of understanding of the rubber meeting the road. There's a particular challenge in deploying capital. How do you do that in a smart way that, kind of discovers the right place to put your capital? What is the market inefficiency that a hedge fund can discover and then trade on? But in both cases, with hedge funds and with VC, I came to see that the process behind that intellectual discovery really matters. The morale of the team, the cohesion of the team, the way you manage, incentivize, organize it. All of those things are the preconditions for these intellectual insights about markets and inefficiencies and ways that you can generate alpha. And so I ended up writing, I think in both cases, much more about, the structure of partnerships, why it is that in VC, becoming a partner is something that, a decent, there's going to be 4, 5, 6 or more partners at most VC firms. Whereas there are some quant hedge funds where they have far fewer partners. Why is that? And I think it's because, in a world where investments are super discretionary, like in VC, and you've got in Series A anyway, 2 founders who come into your office with a slide deck and a dream, and how do you even sort of evaluate what the market size would be? There's no price earnings ratio, all that stuff. The way you get at those subjective with whom you can discuss whether it's a good investment or not. And so your kind of intellectual peers and colleagues and collaborators in the partnership are super important. And it's not like a systematic hedge fund where there can be a team of brilliant quants, they're building a trading system, but they're not making these subjective decisions, putting the trigger on this super big uncertainty. And I think that means you don't need the partnership structure so much at, say, Renaissance Technologies or Two Sigma, or one of these big systematic firms.
That makes a lot of sense to me, actually. You have less information, so you want to debate it more. You want to have more, dialogue around it. Makes total sense.
I mean, I came up with sort of a two-sided matrix in a way. There's, if you ask what drives more partners being created in an investment firm, one thing, obviously, you get bigger and you want to prevent a brain drain. So you elevate people to partners. So size correlates with more partners. That's pretty obvious. But then I think this other side of the matrix is where you are on the spectrum between systematic trading and discretionary trading. And systematic might mean Tiger Global, right? That is not a computer system driven, but they certainly have a system, and they can outsource a lot of their work to consultants because they kind of got a formula. And therefore, as best I know, there are really 2 partners only at a relatively big firm, Scott Schleifer and Chase Coleman.
Yeah, they were just looking for a certain profile of a SaaS company. What's the revenue? What's the churn? They tried to productize that, I guess, or make a algorithm. And yeah, I heard they were outsourcing people to just go evaluate companies and tell them yes or no. And then yes meant put money in at this valuation. It makes sense. And I will see if that works for them. I suspect it's going to be a rough road ahead for them, huh? All right. More insights, Presh. Who's next?
All righty. Charlie, want to go up next?
Yeah, sure. Love the book, Sebastian. But one of the things that really stood out to me, and I think it's hearing Jason talk about this all the time on our team calls, is the never underestimating anyone that was mentioned in chapter 4. And just, it's so awesome when we get to have Roelof come and talk to some of our accelerator companies, seeing Jason's kind of strategy of investing and seeing that, like, I felt the influence reading through, Don going through and talking and not underestimating Jobs, trusting his network that they introduced him for a reason, but still evaluating it and coming back later. And, in chapter 13, kind of when you were diving into the Sequoia piece of just really seeing how that influenced his decision on, some of the best founders being harder to work with and not to, put anybody out. But then I was also kind of connecting it to now where he still sold relatively early compared to some of the others that were in with Apple, and just how that might have influenced Roloff's decision with the new Evergreen Fund and all of those kind of things was just an interesting kind of impressive way of threading the needle. I really, really appreciated that part of the story.
Thanks. I mean, I think the key transition for Sequoia was the experience of investing in Yahoo, and that scene where Mike Moritz is with the two founders, Jerry Yang and David Filo. And in comes Masayoshi Son and says, I want to invest 100 million. And on the one hand, they don't want the money. And on the other hand, they have to take it, because if they say no, Masa is threatening to invest in one of their rivals, another internet directory. And so they have to take it. It's like this Godfather moment, it's an offer you can't refuse. And then Masa makes way more money after the IPO than Sequoia does, because although he didn't find the company, he didn't do the Series A, he didn't find the CEO that was brought in from outside, didn't kind of help to build a business plan, didn't do anything really, but just wrote a really big check. And in dollar on dollar terms, he had a lower multiple, of course, but on dollar and dollar, he just made more dollars. And Mike Moritz, who is one of the most competitive people I've ever met in my life, didn't like that. And so the first thing he did was to persuade his partners to hold on to the Yahoo stock after the IPO, which in those days was not the normal way to proceed. And then out of that grew Sequoia's determination to have a growth fund, and now the Evergreen Fund.
I find it interesting that they're doing the Evergreen Fund, the timing of it. So when you think about Sequoia's conviction, they announce this thing, the market collapses, and I have full certainty that their conviction will carry through the down market and that they'll be proven right. But boy, talk about a crucible moment for Roelof. He always talks about the crucible moments. He launches this Evergreen Fund before the market collapse. They knew that was a possibility, I'm sure. But there is something about conviction, that keeps coming up in the book. I was wondering, I hate to use my moderator privilege, but maybe you could speak to conviction and why that's important, when it can get you in trouble, and how that relates to just the legends and how they became legendary in the business.
Sure. I mean, there's a sort of saying in hedge fund world, it actually goes back all the way to Keynes, I think, the market can stay irrational longer than you can stay liquid. And so too much conviction will get you taken out on a stretcher, right? You hold your position in some leveraged currency trade and it moves against you another 2% and you're done. And so conviction is a sort of scary idea to some hedge fund traders. But in VC space, you're not leveraged. You're buying these one-sided options and you need conviction. And what's more, if you're doing startups, they're going to go through these bumps and you have to stick with it and you mustn't give up. You can, deliberate and wonder and scratch your head and hesitate before you write the check. But once you've written the check, or once you've made a decision, like doing the Evergreen Fund, you kind of need to stick with it. And there's tons of stories in the book about that. One of the good ones I think is, right after the investment in UUNet, which was that early internet company building the pipes of the internet. The first board meeting, the Series A investors show up and a whole bunch of receipts of invoices have been discovered in some dusty box. And the company owes some enormous amount of money that they overlooked. And some decent chunk of the Series A checks just go out the door to pay those invoices. Now, some financiers might just give up we back these people. They've immediately told us that they've, got whatever, 300K worth of invoices or whatever it was. But no, these venture people just renegotiated the terms of the deal a bit, gave some more capital, and sold it on. And then UNet was a massive home run. So it's just one example. But I think, Sequoia's been through the evergreen kind of thing before. In fact, almost all the new businesses, or maybe all of them that it has launched, whether it's going into China, where they had to fire one of the two people they initially hired because it didn't work out, going into India, where the entire founding team quit on them and they had to reboot the whole thing, going into growth, where the first couple of funds were terrible. In fact, they launched, Jason, this is a close parallel to what's going on right now. They launched a growth fund right before the 2000 NASDAQ crash. And guess what happened to the growth fund? I mean, it was completely underwater. And they had to plow back their own carry until they finally returned capital to investors.
Which firm was that again that did that?
That was Sequoia.
It was Sequoia. Yeah. This was an amazing thing. I was like, wow, they are not going to take, and if I read it correctly, they took the fees and they took them from the fees and just said, we're not going to take our fees, we'll just invest in the companies.
Exactly. Well, they made new investments, or they plowed it into later rounds of the good investments, and that
Such
way
a power move.
Yeah. And again, it goes back to the reputation point, right? If what you've got is reputation, you don't want to spoil it.
I just asked people, Presh, to use the raise hand, so maybe you could.
Yep. We got
these
some.
are incredible questions so far and great insights. Thank you, Sebastian.
Francis, want to go up next?
Hi, for the very best VCs, what do you think was the key factor behind their success? And thanks for doing this, by the way.
Sure. I mean, it strikes me that there are three qualities that most of the VCs that I write about seem to have. One is some kind of technical thing they bring to the table. It could be that they know engineering, or it could be they know go-to-market, but some sort of skill which will enable you to help the portfolio company after launch, and therefore that enable you to get the deal in the first place. I think the second thing is embeddedness. Like, you need a network, and it's interesting how this is going to pan out in the next few years, because historically the network was, you've been in the valley in that tight geography for some number of years. Maybe you've been to Stanford. Maybe you've worked at, a key firm like PayPal or something, which has a sort of, supernova event, and people who knew each other there went off and did different things, but you have a network. So there's the technical thing, the network thing, and maybe the other thing is, sort of a general financial business, which is sort of a bit like the technical, but it's some combination of knowing either engineering or go to market plus a general business school type of thing. I don't think you need all of those, but you probably do need two of them. And other than that, what is it? It's the ability to have the EQ as well as the IQ. The EQ, you need to bond with an entrepreneur and persuade him or her that your capital is going to be good capital to take, because you're going to work together closely for 7 years or something, and it's going to be okay because you're a good guy or a good person. So EQ and IQ, hustle. I mean, this is a game where it's all about network and putting people together and creating connections between, any portfolio company you just backed last month and the first 5 engineers that portfolio company might hire. So connect, social, the willingness to go out and constantly nurture networks strikes me as important too. When I wrote about hedge funds, there were jokes about certain macro traders who sat behind their screens, never talking to anybody, but just kind of following the markets and figuring out the trade they wanted to do. And when one of them bought a private island, it made no difference because he was so insular already. You can't be like that when you're a VC. Clearly, you've got to be way more sociable.
Awesome. Andrew Meyer.
You talk about conviction being important, but is there also an element of recognizing what's happening in the overall business environment and sensing the direction that the wind is blowing for your convictions and timing to pay off? Or am I imposing that afterwards?
No, I think that's a very insightful question. In fact, one of the ideas that I picked up on initially from Accel was that, when they formed the partnership in 1983 and they were trying to differentiate themselves, they came up with this quote from Pascal, I think, the 19th century scientist. He said, chance favors the prepared mind. And so they did these prepared mind exercises, just like you're suggesting, where you survey some emerging technology, you figure out what kind of company needs to exist to make the most of that technology. It could be, say, the cloud arrives and now you suddenly need new identity and security companies that are going to work in the cloud. And you not only imagine what kinds of company might be needed, but also what types of person would be the likely founders. So a good example that Accel emphasized to me was, if they hadn't done a prepared mind exercise around the arrival of social media and realized that the founders might be, super young, not particularly credentialed, right, but have a great idea for something that's going to take fire amongst users, that could be the profile. And they'd had this experience with Skype, where the founder, Niklas Svenstrom, was kind of a bit strange and had, there was some kind of reason that, he'd got in trouble with peer-to-peer stuff and he couldn't come to the United States for legal reasons. And so, it was not a typical investment, right? So they hesitated over backing Skype and they didn't do it. And of course, went to the moon. And then they did this big kind of, sort of post-mortem and figured out, okay, we have to prepare our minds on this. And they decided that the next social media company might well have a strange, very young, very strange, something kind of founder. And that it wouldn't matter if you just looked at the usage metrics and what the derivative on that was, how fast they were exploding. Never mind what the founder looks like, just do it. And then along came Facebook. And it was a good thing that they had that preparation, because there was this, whatever he was at that time, Mark, 19-year-old who wouldn't look you in the eye and had a business card that said, "I'm CEO, bitch." For a traditional venture firm to get past all of that, they needed to have a prepared mind.
Thank you.
The funny thing about Kazaa, the Skype thing with Nicholas was, they had done Kazaa earlier, licensed the peer-to-peer technology to Skype. Kazaa was a complete disaster because it was used to steal movies. And people couldn't get their heads around backing somebody who was a pirate, literally. And it was a Nordic country, which is not where unicorns came out of. So yeah, if you didn't have a prepared mind that they had figured something out with peer-to-peer, which is now distributed computing, which is now all of Web3, you just couldn't get your head around it. But if you had used Kazaa and you had stolen movies and seen the power of like how fast it was when 100 peers would send you a movie compared to downloading it from one server, you got it immediately. But you had to have been a thief using Kazaa to understand it, which a friend who is not me had used and understood it implicitly. But my friend wasn't an investor at that time.
All right, George Clay, you're up next.
Yeah, in chapter 9, there was a couple of Peter Thiel quotes that I really liked. One of them was, venture capitalists should embrace contrarian and singular founders. The wackier, the better. And the other one I really liked was, the art of venture capital was to find rough diamonds, not spend time polishing them.
Yeah, that's Peter for sure. I've debated a bit with him since my book came out. He had me to speak at his firm, and that was fun. I get the sense that he, I mean, maybe I'm wrong, but I think he slightly overstated how much he really has conviction on this notion that you make the investment and then you just don't help the firm. It's just a waste of time. It's counterproductive. It's actually a negative return on your time, because it's much better to spend time as an investor looking for the next great deal than to worry about helping the last deal you did. And I just think that's a pretty extreme position to take. And sometimes when I talk to him, I feel like he doesn't quite believe it himself either.
Awesome. Mike Savino.
Thanks, Presh. So, Sebastian, in the book, you talk about how pass-through LLCs and capital gains treatment served as catalysts for venture capital on the investor side. Did you, in the course of your research, did anything come up about the investor side treatment by government, and specifically bankruptcy protection? You know, Jason and I teach a class on angel investing, and in speaking to people from Australia and Italy, one of the things that became clear to me was it's not quite so easy for a founder to borrow or take money and not be kind of on the hook for it for life. And then another example more recently is China's treatment of Jack Ma. So just curious if founder treatment of risk-free capital came up in conversations.
Well, the Jack Ma stuff obviously has come up a lot. I mean, this disappearing billionaire phenomenon in China is huge, and it does spark, I think, a real disagreement amongst China observers. On the one hand, you've got people who say, look, there's tons of great engineers in China. It's true that if you look at not only which country generates the most academic papers in STEM, but which country generates the most academic papers in STEM that appear in the top 1% of cited papers. So that's taking out the bad papers, basically, and just looking at worthwhile papers. China wins. I mean, China has, like, in the top 4 or 5 universities, they're kind of 3 or 4 of them are Chinese, and Stanford is the only American one that makes it in the top 5. And so, China has huge strengths going forward in tech businesses. And I do think that, there's a lot of path dependency again, whereby, every time you create a unicorn, you've created a cadre of people, let's say 50, 100, whatever, who have been inside from the early stage and have experienced that scaling from the inside. And it's just the most exciting takeoff experience in your life. And you want to do it again. So some proportion of that 100 people are going to spin out and do new companies, or be an early recruit to a new company, or be an angel or something. So I think these ecosystems, once they get going, have a lot of momentum. And China has a lot of entrepreneurial momentum, a lot of tech momentum. It's still a very big market. It may be growing less fast than it used to, and the real estate crisis in China is very severe, but it's still got a higher growth rate than the US. Okay, so there's the view that, look, disappearing billionaire, not great, but China will still be a terrific place to make tech investments. I tend to the more skeptical view that, yes, current entrepreneurs and investors are locked in. They have illiquid assets in terms of companies they're building. They can't just leave. But I bet those people who are building companies and building wealth are telling their 18-year-old kids to get the heck out of the country and go to Canada or wherever they can be accepted and build their lives somewhere else. Because who wants to build wealth in a country where you get your head chopped off? So yes, I come down on the side that, property rights and just basically human rights for everybody, including and especially the founders, are just super important. I don't have much to add on the bankruptcy rules, I'm afraid. I just don't know about that.
Great. Thank you, Sebastian. Sheldon, you're up next.
All right, thank you, Presh. In the book, you were able to contrast the differences between Boston and the Bay Area in respect to their startup ecosystems. My question is in regard to the record migration of individuals out of the Bay Area and into places like Austin and Miami. What do these cities have to get right in order to create the proper scaffolding or foundation for a successful eco-venture ecosystem to take hold?
Well, fundamentally, venture and entrepreneurship, it's a two-sided market. You need the smart people who are going to found companies, who need to be ambitious and have some commercial sense combined with some product sense. And then you need people to finance them, partner with them, support them, and connect them to a network and to a sort of strategic vision of the landscape, to kind of be their advisors. The founder's heads down doing the work, and the venture investor is more like the map and the territory. And you can do that in Miami, you can do that in Austin. And I think the interesting question is whether, in a world of remote working and efficient Zoom communications, I mean, I'm talking to you from Scotland right now. Maybe the old thing of geographic concentration doesn't matter, or matters a bit, but matters way less. And so therefore, it won't just be Miami and Austin, it'll be, Boulder, Colorado, and lots of places. I think that's, as with many things post-pandemic, where we haven't yet quite discovered where we land, and the balance between sort of physical proximity and Zoom proximity is not totally clear yet. But I mean, if you've got a big market like the US, in principle, you can be anywhere so long as you get that two-sided markets of the venture investors meeting up with the entrepreneurs.
Thank you.
Great. Molly Wood.
Hi again, Sebastian. I actually have a similar question, and I'm going to build on it a little bit. And one is about, like, of course, we all know where this industry was built, Silicon Valley. We know that has been the priesthood and the concentration of wealth and power for a long time. And so I was hoping you could expand a little on your last thought in terms of whether Silicon Valley you think is going to remain dominant. But on the same theme, we're also seeing these real changes in fund structure, whether it's launching a growth fund or raising in public, or, we interviewed somebody today about creating a DAO and using tokens to create a mechanism for investment. And so I wonder, as you look ahead to like a book 2, what do you think are the biggest, assuming that's going to happen, hope springs eternal, what do you think are the disruptions to the industry as we know it or have known it?
Well, I'm not so sure about DAOs. My suspicion is that there are certain things on which people are very happy to collaborate, like Wikipedia, and that's a fantastic example, pre-DAO, of course, of a collaborative online venture which has created something of enormous value. But writing Wikipedia entries is something which a lot of people do for fun because they're just curious and interested. And they enjoy it. Open source code, that's another interesting example where, as I understand it, there are whole chunks of the coding process which people find interesting, a bit like Wikipedia, and they're happy to contribute to an open source project. But then there are also bits of the open source which are kind of boring to do. And in order for the software to be useful to a consumer, you need to actually do the boring bits as well. And for that, you need to pay someone to do it because it's dull. And so it ends up being the case. Others on this call may have a more detailed grip on this than I do. But what I'm told is that, nearly all the open source code that's been shipped is actually sold by a company because the company structure is needed to fill in the bits where volunteerism is not enough. And by extension, I think DAOs, could work for certain things where people are enthused enough to just come together on a voluntary basis. But I'm not sure that that's a lot of commercial things, which end up creating products that are used by millions of people. Maybe I'm missing, sorry, the other part of your question, Molly, before.
Oh, I think it relates to the other part of the question, which is, do you see power in Silicon Valley and in these really traditional fund structures waning as we have geographic diversity and even fund structure diversity that, hadn't existed before?
I mean, I think fund size and specialization, that has really changed, right? So before the 90s, there weren't really seed investors. Then seed investing broke out and it kind of got institutionalized in the 2000s. So that's new. Growth investing, Massa came to the Valley. It was a new thing when he did it with the Yahoo deal. And then it really kind of became entrenched in 2009 when Facebook raised from Yuri Milner. So these the seed and the growth are new. The Tiger Global approach to the world is new. So there are new structures. And I think that specialization, which has grown and deepened all through the history of venture, will only continue. That in order to persuade the entrepreneur that your money is greener, you need to have more detailed knowledge about what it is the entrepreneur is doing. And that points to specialization being probably an enduring trend. And on the geography, again, there's just like this question about, how Zoom-minded are we in the end? And I suspect the answer is going to be hybrid, and people can Zoom up to a point, but they'd rather have face-to-face contact sometimes. And so there will be an advantage to being in a tech hub like the Valley, but not everybody will want to pay the cost of being in the Valley, which might be partly just real estate and rents and partly psychological. They don't like it, whatever. And those people will have more of an option than they used to of going to live somewhere else and still participating in the tech ecosystem in a meaningful way. So it's good.
Awesome. Jay, want to go?
Yeah, thanks, Presh. Sebastian, really enjoyed the book. Thank you so much. I enjoyed the story. I was not familiar with Paul Graham and creating YC, how he kind of did it, because then we get bombarded by all the founders' questions and kind of organized them into cohorts, which seems obvious now. That was a big surprise to him. What was it? Any surprises that you had in the writing of the book?
I think the biggest surprise was China. By the time I started writing the book, I expected that I would be able to show that venture had been super important to the origins of Silicon Valley, and that Silicon Valley is not Stanford Valley. Silicon Valley is not because of defense contracts. Silicon Valley is because there was this extremely risk-friendly type of investing with a power law mentality, and that made all the difference. What I didn't expect was to find a similar story in China. I'd read things about China, Kai-Fu Lee's book and so forth, and it emphasized the role of the government in backing tech. And it was only when I actually went and sort of spoke to the people who knew about the origins of the consumer internet in China and how Baidu, Alibaba, Tencent, Sina, Sohu, NetEase, EachNet, Ctrip, how all these companies got formed in the early days of the late 90s, early 2000s, and all of them had US style venture money. And typically they had, a Cayman Islands parent, dispute settlement under New York law, Silicon Valley lawyers, so that you could write equity options to attract employees. Equity options were not a thing in China. In fact, equity, just public equity on mainland China had only been around for like 8 years at all when Alibaba got started. So what was extraordinary to me was, how much it was not merely the case that Silicon Valley got started with VC as a central driver, but also China got started in a technological sense with VC as a central driver. And I think, what's been cool since my book was published, and I've, received lots of, people who want to chat and do Zoom calls and so forth. And I've spoken to more people in India and Africa and, around Europe and stuff. I think this story kind of repeats everywhere, that in say Europe, take Europe. Europe has more software engineers total than the US does. It's got a market with more people and more GDP. Now, the market's a bit fragmented. There's different languages. There are disadvantages, but it is certainly a continent with the technological sophistication and the economic weight that would lead one to suppose that there would be more than just like SAP in Germany, right? And yet 10 or 15 years ago, that's pretty much all there was. I mean, Europe had created just about zero in terms of tech. Why was that? Why was the US not just like 3 times better, but infinitely better? And I think it was because the lack of venture capital. And now venture capital has come into Europe. And you've got firms like Accel and Sequoia and Lightspeed and General Catalyst and Index Ventures doing deals in Europe. And guess what? The ecosystem is growing fast. It's really taking off. And you've got, the Spotifys and so forth. So I think that's been the surprise, how this theory, which, when I wrote it, it was, a slightly contrarian thesis that, there'd been this debate in academia. Does venture capital contribute to innovation, or does it merely show up for it? And I'm heavily on the contributed strongly side. And I'm just sort of feel surprised, but also kind of happy that the theory seems to work outside the US as well.
Great. Justin, want to go next?
Sure. As we try to expand opportunity and diversity in this industry and get more voices around the table, in order to accomplish this, it takes a ton of intentionality. What are some of the firms that, amongst all your research, that you believe have done this the best, and in a way that's also meritocracy and in which everyone can be around the table?
Well, in my book, I describe somebody who wanted to do this, but didn't do enough kind of managerial grunt work to actually deliver on it. And that was John Doerr at Kleiner Perkins. I mean, I think he really genuinely wanted to promote women. He moved to Silicon Valley in the first place in the 1970s because the love of his life was one of the few women engineers at Intel. So a pretty unusual woman. He moves to Intel, moves to the Valley, joins Intel as a salesperson, and succeeds in marrying his sweetheart. And then they have 2 daughters, and he really believes in smart women. And so he started hiring them. And the upshot was a sexual harassment suit. I mean, it was a disaster. Why? Because he didn't change the culture of Kleiner Perkins. He hired the women. They were very smart. Many of them have done terrifically well since, after they left Kleiner, like Aileen Lee. But he did not change the culture of Kleiner to make space for these women to flourish as they should have done inside the company. So I think that is an object lesson in how you got to follow through. You've got to do cultural change, and a sort of, VC firms, which maybe by tradition are kind of not heavily managed. They are too small to feel they really need to be managed. John Doerr handed out, instructions on KPIs to Google, as he wrote in that book. But inside his own partnership, when he was leading it, not so much. So I think, intentionality, word used is very apt. Who's done it well? I don't know if I can single out one partnership. I mean, I feel like everybody's getting the message, and everybody's progressing somewhat. I do mention in my book that Accel was not particularly early in hiring women, or didn't stand out for how many it hired. But what it did get right is that at least a couple of them rose to the very top of the company. I mean, the woman who their office in London, which is pretty successful, is co-led by a woman, and in fact, in practice, she is the star of the show. And they had I forget her name now, but the US partnership, I think the lead partner for a while was a woman. So they've done quite well. But again, I think there's plenty of examples of this where I think this is really changing. I think, race is tougher, and that's the next big challenge for diversity.
Yeah, it does seem to me also the creation of women-led firms is a big change. It might be hard to change the culture of a 5-person fund that's had the same 5 partners for 6 years and 4 of the same ones for 12 years and 3 of the same ones for 20 years. Things move glacially slow. It's almost like tenure at a college or something. It's just really hard to change the culture. But if you create a new culture, and we've seen Mary Meeker, I'm blanking on the woman's name from, Molly will help me, from Andreessen Horowitz, who left after just 2 years to start her own crypto fund. A couple of, very sizable funds now. So the LPs, I think, have a super appetite to see this change, and they're betting with their dollars on the best fund managers. I perceive they look at returns and qualifications, not gender or race.
There is some cool research I cite by Paul Gompers, or co-authored by Paul Gompers, I should say, from Harvard, around the fact that when you have all male venture partnerships, and then one of the men has a daughter who reaches kind of mid-teens, performance goes up, because the male partner now is suddenly more attuned to smart women and more willing to listen to a pitch from a woman entrepreneur, and less blind to the opportunities that he might be passing up if he doesn't listen hard.
Can confirm.
All right, Simon, want to go up next?
Sure. Thank you, Sebastian, for the really interesting book. Early on in it, you talk about how Rock had said that it was all about the people, and that's what his whole investing philosophy was, looking at them. And because certainly there's no financing at that time to look at. So I wondered how right you thought he was about that, or what you think that mix is, because obviously others like Tiger Global think totally differently.
I think Tiger Global can afford to think differently because it's investing at a later stage. And so anybody who's founded a company and led it to the kind of valuation at which Tiger Global becomes interested is clearly able to lead a company. So I think that's not 100% true all the time, but it's mostly going to be true. And so it's not the same thing as evaluating a Series A deal where this person has a product idea, but who knows if they can manage the company. And then you have to really think about their character and try to assess it and see whether you think they've got what it takes. So I think we can set the growth investors aside a little bit. I'd say that Rock, he did emphasize people a lot. I mean, that's partly because he was himself completely non-technical. So he had no idea whether, SDS, one of his investments, was going to be technically fantastic. He could look at their credentials on a resume, but he couldn't really assess it himself. What he could assess was kind of the thought process, and I think he spent a lot of time with people, listening carefully before he invested, to see if they contradicted themselves, to see if they exaggerated, to see if they were honest and facing problems and admitting where their idea might be tough to realize. So he looked for those kinds of gritty honesty signifiers. I think that worked for him. And later there was a bit of a debate between, technology-led investors like Tom Perkins, by repute, and sort of market-led investors like Don Valentine, who cared about the market size and said, well, if the person is no good, we can just fire them and get a new CEO. And so the guys, this tech-led people, tech-led VCs, people-led VCs, and then market-size-led VCs. But again, it's one of these distinctions where one's talking about difference of emphasis, perhaps, but most VCs were looking at all three in some fashion, and they would be kind of crazy not to have done so.
Great. Andre LeBlanc.
All right. Thanks, Sebastian, for the book. One thing that was really valuable for me was following the history of venture throughout the book and seeing those key moments and key deals and companies that really shape moments in time. One example being, the rise of Founders Fund and young entrepreneurs and saying no to venture. I'm curious if in the book there was anything that you weren't able to include that you wanted to, a key company or story or a deal.
Gosh, I mean, there's always tons of material that doesn't fit. And almost by definition, you should always cut a lot because you'll be cutting the less good stuff. So the residual should be higher quality. What did I particularly, so I think the thing which I only cut towards the end and which I kind of liked, but there's a reason why I cut it, is that, there was one day I was visiting this guy, Arthur Rock, who was in his 90s by then, the father figure of venture capital, the person who backed Fairchild and then Intel, and as well as Apple and a few other big hits. So there he was, this whatever, I think 91-year-old or something. And I would be reading his files, and then he would put his head around the door and said, "Anything interesting?" And I would go in his office and we would talk a bit, and then I'd go read some more files. And one day I was in his office and I look around and he's got all these sort of plaques and trophies and photographs on his windowsill. And there's this banker's check for $100 made out to him, signed by Hunter S. Thompson, as in Fear and Loathing in Las Vegas. And I'm like, whoa, why do you have a check here from Hunter S. Thompson? And Rock says, well, we were friends and we had a bet on the outcome of the 72 election and I won. So he wrote me the check, but I figured, Hunter Thompson's signature was worth more than $100. So I just kept the check. And I said, you were friends? How did that happen? And this led to me uncovering a whole kind of side of Rock's life, where in the late 60s, he got divorced and kind of went wild for a bit and tried to do the sort of 70s drug thing and hung out with Hunter S. Thompson and this invested in Rolling Stone magazine and, sort of tried to kind of reinvent himself. Didn't really last very long. And if you look inside Hunter Thompson's writings, there's this character called Arthur Rock who shows up from time to time, including in Fear and Loathing in Las Vegas. There's this hilarious scene where, Thompson and his attorney, as the other guy is called, sort of throwing up in a hotel room, and a hotel worker comes to the door and they're so embarrassed and they're throwing up and they're half naked and it's just a complete disaster. So they decide to intimidate her by saying that somebody called Mr. Rock would be coming and asking for information from her. And so there's just like this wild stuff about Arthur Rock and his connection with Thompson. And I thought it was fun. I put it all in. But then in the end, it was fun, but it kind of didn't tell you anything about venture capital. So I cut it out. But there you go.
Awesome.
We have time for one more.
Yeah. Ivan, want to go up next?
Hey, everybody, and thanks for doing this, Sebastian. I think you're a really thoughtful guy. This is for Jason. There are no market-based solutions to the Gulf Stream reversal, to the deforestation of the Amazon, to the ice sheet disintegration, to the ubiquity of petrochemical pollution and to extinction. Please stop spreading unscientific lies about oil and fossil fuel being a market-based thing that we can fix. It's a tipping point.
Okay. Yeah, I guess you're referring to maybe Friedberg saying he believed in the market-based solution for EVs on All In a couple episodes ago.
No, not just EVs. You guys constantly do this every week where you talk about things that we have no scientific basis to reverse, and you act like it's something that the market can fix. There's simply no way that we can fix these things and have it be profitable, especially without government action.
Yeah, I don't disagree. I believe the government has a role to play.
Well, let's see it then. I never hear it from your podcast. You guys are influential. How many listeners do you have? You keep saying that there are market-based solutions to these things.
I think you're listening to a podcast with 4 capital allocators. Our role in the world is to empower entrepreneurs and to work in the confines of the market-based solution. We're not 4 politicians talking, but if you were to tune into the Sunday shows, Meet the Press, et cetera, you could listen to 4, 5, 6 politicians talk about what they're doing. So while we are influential in capital allocation and free markets, I would never look to the All In podcast or venture capitalists to solve the problems that politicians are charged with solving. So I appreciate you pointing this out. And I think you're just need to listen to the other pod, Meet the Press or McLaughlin Group. Those are great places to hear politicians talk about these things. And it's a race to see who will be more productive, the free market or what they're doing. Right? We could argue all day long about which works better. What do you think, Sebastian? Which works better for climate change? Do you think climate change will be solved by the free markets primarily or politicians? Who do you think is going to have a bigger impact in the coming years? I'll ask you, who do you think is going to have a bigger impact? Obviously, both have to be involved. Thanks for your question.
Yeah,
Evan.
I mean, I agree with the last bit of what you just said. I mean, I just feel like it's rather than fighting each other about which is going to be the solution, the obvious point is that the government has a big role, right? Because it's got to ideally set some kind of price around carbon or cap it, or at least regulate in a way that drives the system in the direction of carbon alternatives. And once the incentives have been set intelligently by the government, the private sector will be good and effective at delivering market-based solutions. And it's a combination, it's a partnership. And so, I mean, there's another version of this debate, which is, which is more important for innovation, the government and DARPA and all that stuff, or venture capital? And it's just like a dumb debate. I mean, the government's super important for basic science, and venture capital is great at commercializing it. You need both.
Yeah, I mean, one could argue with GPS, like, who is the GPS obviously created for the military and decades in the muck trying to make it affordable, and then which companies actually benefited most from it, or which distributed at the highest level? Google Maps, perhaps Uber and DoorDash are the primary beneficiaries of pushing them. And of course the smartphones, which included the chipsets that drove them down. So it is always a collaboration. This has been 1 full hour with Sebastian Mallaby. A great book. Everybody buy it for your friends. And we really appreciate you and can't wait. Are you going to do another book? What's it going to be? You got another book in you? Or are you researching one today?
I definitely have another book in me. And the question is which one? And there's a sort of struggle going on inside my stomach, I think, right now, various contenders.
Really? Are you going to do a book on crypto? Could you do a book on crypto, or is that just going to be a waste of 5 years of your life? How do you look at the crypto market? Do you think that would be like, my fear as an author would be spending all that time to write it, and the whole thing is just a grift and a fraud.
Yeah, but that's an extreme version of the fear. The less extreme version is, so much is going on in crypto that something is going to stick, something's going to work. That's kind of my view. But at the same time, we don't really know what's going to work. There's plenty of, I have looked at this in some detail, and I think there are lots of applications where you think, yeah, probably, but not for sure. And so you don't know what, with venture and the history of venture, it's clear what the narrative lines were going to be. What were the deals that mattered? What are the companies that people remember? What are the firms that people remember? We know that because it's the history that goes back, 60, 70 years. But with crypto, as I've discovered from talking to crypto people, there's this phrase that comes up within about 15 minutes every time, which is, I ask a question and the answer is, it's super early. We don't know. We don't know.
Super early, but we're in the second decade. I vacillate between agreeing with them that it's super early, but then still expect something to have been delivered that's tangible and that, 1 billion people use every day. I don't know. Just for the amount of money deployed, it just feels like we haven't gotten enough out of it. All right, listen, Sebastian, great job. Appreciate you. Everybody buy the book. Buy for your friends for Christmas. Buy 10 copies for your company. All right, I'll talk to you soon. See you next time, everybody. Bye-bye.
Bye-bye.
Thanks, everyone.
Thanks,
Sebastian.